And when banks get into sequential failures, it's the savings are lost, that the panic is far worse. So there are a number of ways that AI could accelerate. Again, this is about accelerating and making worse a banking panic. And I'm not bashing AI. I'm not bashing AI. It's not a futuristic book. AI is already here. It's in all the places you mentioned, your car dashboard, and Alexa and Siri, and all over the place. So it's here. It's installed in a lot of systems. I know of hedge funds that are actually using AI to pick stocks, and it's not just doing some basic research or looking at footnotes and financial statements. It's actually selecting the stocks and executing the trades. I mean, they're humans who keep an eye on it, but the AI is doing the trading. It's also ubiquitous for registered investment advisors making portfolio recommendations to clients. Traders are using AI again to come up with ideas to interact with the markets. So it's here. A lot of good will come from it. And I mentioned specifically applications in biomedicine and coming up with drugs for treatments, et cetera. I mentioned it because it's important and it's happening, but that's not mainly what the book's about. What I do, I take AI, and I know a lot about it. I've built deep learning models. I built them for the CIA. I built them privately, et cetera. So I know how they work with the nodes and the edges and the layers and the machine learning. And so you take a billion inputs, put them into what are called nodes. They're mathematically processed. They produce outputs. The outputs then become the inputs to the next layer and the next layer, et cetera, until finally you narrow it down to some kind of recommendation. So I have a very good working knowledge of how it works. And then with GPT is just a branch of AI. It's the one that's getting a lot of the buzz lately because it can write and produce. College kids are using it to do term papers. So that's maybe cheating, but they are. I mean, it's just a reality. It can talk to you. They can produce images, etc. So that's the kind of interactive front end with images and voice recognition. But it's really just a branch of AI. But I look at all this and I make the point that yeah, there's a lot of good that will come out of it. It's here whether we like it or not, but there's some hidden dangers. And one of the ones I point to in the stock market, there are a couple. One is we tend to anthropomorphize things like AI. Now that just means we give human characteristics to things that are not human. So
Mm.
Alexa may have a nice voice, and you say, Alexa, turn down the lights, and it does, but it's not human. It's a machine. It's all math. I mean, when you deconstruct it, it's all math. It's not your friend. But we tend to treat them as friends. We give them human attributes. That means we trust them in ways that they probably shouldn't be trusted unless you know all of the flaws in them. That's really what I'm doing, is highlighting some of the flaws. So that anthropomorphization, treating them like friends when it's really just math, is a human fallacy, but it's a mistake. The second one I point to is called the fallacy of composition. Now, what is that? That's basically what it means, is that a strategy that may be very good and very smart for a single individual can be catastrophic if done at large scale. So, the simple example, you're at a football game and you don't have a very good view because the person in front of you is too tall or they're wearing a hat, and you stand up to get a better view. Well, that works. The minute you stand up, you have a great view of the field. That works for you. But what happens next? Well, the person behind you stands up, the person behind her stands up, etc. Before long, the entire stadium are on their feet. Nobody has a better view because relatively you're back where you started, and everybody's worse off because you're all standing up. So there's an example of it works for the individual but fails at large scale. Now take that over to the stock market. What happens when we have a market meltdown? And they happen. March 2020, the stock market fell 30% in 30 days. It wasn't the biggest crash in history, but it was the fastest crash of that magnitude in history. And what do people do in that situation? Well, for a few days, they watch it. Oh, I'm right. The market's wrong. It'll come back, etc. But then they kind of hit the panic button. They sell everything, get cash, move to the sidelines, wait out the crash, and then when it's over, tiptoe back into the market and start to buy some of those stocks at better levels. Well, that is a really good individual strategy. It's not a bad strategy at all. But what happens when everybody does it? The answer is you have all sellers, no buyers. Markets go straight down. They blow through the circuit breakers. They go through the floor, and regulators actually have to close markets. It's not a question of a timeout or a circuit breaker. You actually have to close the markets, and who knows if it can reopen. So what I do in chapter one I create a scenario. It's a nonfiction book, but scenarios are a good way to illustrate this for the reader, where you've got a couple different actors. One is billionaire family office in New York. Another one is two hedge fund operators, but they're actually criminal masterminds trying to manipulate the market in Mallorca. There's a cyber warfare unit in China. And they're all interacting in ways. And then I have a Federal Reserve chairman who's the last to know, but that's typical of the Fed. They're usually the last to know. But through a combination of deep fakes, videos of the Fed chairman saying things which he never actually said, but then he's on a plane and they can't reach him to deny the remarks. So the market believes the deep fake. It starts going down. The criminals in Mallorca, then they put in all the sell orders. But the Chinese are putting in sell orders at the same time, having waited for the market crash. They're not trying to make money. They're trying to destroy the Western economy. And then markets follow this scenario I described. There's a lot else in there. And it's all having lived through quite a few market crashes in my time. I was able to, I think, add some color to make it interesting. But here's the point. There was no mastermind. The criminals in Spain didn't know about the family office in New York. The family office in New York didn't know about the cyber warriors in China. The Fed didn't know any of these things. Neither did the stock exchange. It happened. It's really a case study in complex dynamics where properties emerge from a complex situation, but nobody's really in charge and nobody really expects it. Now, some of that is human nature. I could point to financial panics going back to the 14th century. But what's new is that when you put AI on top of it, take human nature, fear and panic, and all the things we all experience from time to time, combine it with AI in such a way that there's no one to apply the brakes, no one to take the other side of the trade, etc. This will happen faster and in a more dangerous way than people realize. We just talked about capital markets and the stock market, and that's
Yeah.
fine. The banking system is completely different. I mean, obviously, they intersect because banks are financing stock purchases, but the banking system is a separate, complex system. And it's one that actually the regulators care the most about. If stock markets crash, it's not good, but regulators kind of shrug and go, well, it'll come back, or, too bad. I mean, the NASDAQ fell 80% during the dot-com crash. It came back. It took 14 years, but eventually did come back. But regulators really worry more about the banking system because that's where money is created. You have so much talk about, the Fed's printing too much money. The Fed, they do print money, but it doesn't go anywhere. They print the money by buying bonds, and then the banks that are selling the bonds take the Fed's money and give it back to the Fed. That money doesn't go anywhere. It just inflates the balance sheet. The money that does go somewhere, the money that does drive the economy is actually created by the banks themselves, by commercial banks. When they make a loan, they put the money in your bank account. That money came out of nowhere. The commercial bank created it, in other words. And when banks get into sequential failures, it's the savings are lost, that the panic is far worse. So there are a number of ways that AI could accelerate. Again, this is about accelerating and making worse a banking panic. And I use Silicon Valley Bank as an example that happened in March 2023. It wasn't that long ago. The first warning there is that, we have in the US, but also Canada and Europe, bank deposit insurance. We have the FDIC insures bank accounts up to $250,000 each. In Europe, it's 100,000 euros, et cetera. But there's some amount. But in Silicon Valley Bank, they had deposits in the billions. Cisco had billions of dollars on deposit with Silicon Valley Bank. There were crypto exchanges. When they sell crypto, you give them dollars. Well, they take the dollars and put it in the banking system. And one crypto exchange had, again, $3 billion in Silicon Valley Bank. It turns out Silicon Valley Bank, 97% of the deposits were not FDIC insured. That's an accident waiting to happen. And when you look at what did happen, on the Friday night when the FDIC closed the bank, they initially said, okay, we're closing the bank. Deposits up to $250,000 are insured. No worries, your money will be available Monday morning. But for any deposits in excess of that, we're giving you like a due bill. It was like a chip. They called it a receivership certificate. And they said, we'll get back to you on what it's worth. We don't know when. Is it 10 cents on the dollar, 90 cents on the dollar? We don't know. We have to figure out the size of the hole in the balance sheet, et cetera. Well, first of all, that can take 6 months to a year. Then you have to sell assets to pay people back. There was enormous uncertainty. So then we had what I call the crybaby billionaire weekend, where everyone was, calling the White House saying, "You don't understand. I mean, all these Silicon Valley startups, they've all got their working capital in Silicon Valley Bank, whether it's 5 million or 10 million. You shut it down. They can't make payroll. They can't pay the rent. They can't continue the development." Never mind the fact that 95% of those companies fail anyway. But they were just so finally on Sunday night at 6 p.m., the FDIC came out with another statement. They said, "Oh, just kidding. All deposits are insured." And the next day at a press conference, Janet Yellen basically extended that to the entire banking system. And the Fed, the Federal Reserve, on top of that, said, if you're a bank, a member bank, and you have Treasury securities, send them to us. We'll give you 100 cents on the dollar as a 1 year low interest rate loan, even if they're only worth 70 or 80 cents on the dollar, which most of them weren't because they had been bought at when rates were 2%. At the time of Silicon Valley, rates were up to 5%. Most of those bonds were underwater. So, okay, we had some more bank failures with Credit Suisse and First Republic, and there were two others, five banks altogether. But the point is, we got through it. But then when it was over, I thought to myself, well, what did you, the government, what did you just do? You guaranteed every deposit in the system. You tore up your FDIC ceilings. You said no limit. You guaranteed every bond in the system. You said, who cares if it's 70 cents on the dollar? I'll give you 100 cents on the dollar. What have you got left? You've just guaranteed all the bonds and all the deposits. When you have your next banking failure, what's your next move? Well, there is only one move beyond that, which is to nationalize the banks. So that's how delicate this whole thing is. Now, what does AI do to that, what I just described? Well, first of all, we all remember grainy black and white photos from the 1930s of men. It was mostly men, lined up around, with overcoats and fedoras in the rain, trying to get their money out of a failing bank where the doors were closed. It was too late. The insiders had already taken the money. Well, today it's no different. It's just called a run on the bank, except we take our iPhone, we tap a few things, we can send $1 billion just like that, and then we text our friend, "Hey, get your money out before it's too late." It happens almost instantaneously. Number one, and number two, these AI algorithms tend to exacerbate the situation. They can be used to identify where the next banking run is going to be. So the main impact of AI in a situation like this, it takes all the danger I've described, which has been around for the history of the banking system, which going back to the 16th century, if you will, but it accelerates it, it amplifies it, it happens much more quickly than people realize, and the results next time will be catastrophic.